Konstantin in his last piece was talking a little bit about settlement layers, which I think is a nice transition into what we're going to get into now. This next format, again, we're going to a panel, and it's on settlement layers. We're calling it the settlement layer shift, why businesses are eyeing blockchain for cross-border payments. We have great speakers representing MANSA, Wirex, and Augustus, and our moderator is Giorgio from Lombard Notes.
Thanks so much for being here. I'm Giorgio. Lombard Notes is my blog, used to be the head of product at Xtalks. We were bought by Kraken a few months ago. Very happy to present this panel. Do we want to start with a brief round of introduction? Nkiru, you want to go first?
Yeah, so I'm Nkiru. I am the CEO and co-founder of MANSA. We're a global settlement platform and provide stablecoin-powered liquidity to licensed payments companies around the world.
Dan?
Hi, I'm Dan, General Manager at Wirex, and we offer retail, business banking, and banking as a service infrastructure that's kind of stablecoin native.
Julius?
Yeah, great to meet you, everyone. I'm Julius. I'm Chief of Staff at Augustus National Bank. We are chartering a US national bank with the OCC and the FDIC to bring stablecoin banking to traditional banking, serving global financial institutions with global dollar and correspondent accounts.
Excellent. So we're going to have a few questions, and we're going to leave a room at the end for Q&A from the audience. I would like to kick off this conversation with something that was already mentioned in the previous panel, which is the dollar problem, let's call it like this. So MANSA is, it's tether-backed, it settles in USDT. Wirex is settling more on USDC and EuroC. But essentially, stablecoin is kind of a dollarization tool in action. And do you expect this trend to continue, or do you think that the settlement layer will diversify around different currencies and more non-US dollar stables will emerge and will be used? You want to go first?
Yeah, sure. I think we all need to remember that the reason why, first and foremost, any type of kind of dollar-denominated currency, whether fiat or stable coins, has been attractive is because the majority of global trade happens within the US dollar, right? So it has done so for quite a while. It is also when you're sending cross-border payments from the UAE to Colombia or so, it always still goes through ultimately that US dollar in one leg or in another because of liquidity, right? So I think the debate around, it's a very dollarized tool, it is literally just a byproduct of how the world has been structured from that perspective. I do think that we are seeing more of an uptick in terms of localized stablecoins being developed, right? But within that concurrency, we also need to see regulation become more favorable, right? And clarity, so that then these localized stablecoins have a path to adoption. And I think there will need to be a world whereby you have these localized stablecoins that can be leveraged, whether it's like the Colombian peso or like a Kenyan shilling, that goes seamlessly, in and out of whether it's the URC or USDT or USDC, right? One, because currency sovereignty needs to exist for nations, and two, it needs to though be driven by central banks, right, to stipulate what that looks like. So I do think there is a future of that, but it will require a little bit of more heavy lifting.
Julius?
Yeah, I think still what I find extremely interesting is that today, the European Union and the US make up 40% of GDP. If you look at global trade, it's like 80%, so you already see the uptick in 2x. But from if you step back, right, then sort of the legacy rails on SWIFT, where dollar and the euro make up 80%, those were formed over hundreds of years, 100 years, let's call it that, by legacy banks, by regulators. And still, if you compare it to stablecoins, which in a way were deregulated, where the market could acted freely, you look at 99% of dollar stablecoin adoption, right? So in a way, it's crazy that if you think that you leave it up to the market and technology to evolve for itself, that then the dominance is even stronger than when you simply look at the legacy system which has evolved over the last 1,500 years. I would definitely say that my prediction would be that market cap remains incredibly dollarized, because it's just by far the most interesting currency to hold and store value in. But I would agree that if you look at the payment volume, that there will be a shift towards more local currencies, at least hopefully, because only then there's true adoption and use cases.
Dan, you want to?
Yeah, I don't think anyone can argue against the fact that the dollar will continue to be like the dominant force. I think there's like, well, I don't know. Put your hands up if you think that actually it's going to weaken against all other currencies, just like proportionally. Or do you think it's going to stay at 99%? Like, who thinks it's going to stay at 99%?
But if you look at the dollar reserves in central banks,
yeah,
they're going down. Over the last 10 years, they went down from 60 plus to 56%. So the wider financial system is going against this trend. Like there is a sort of trend in the crypto and DeFi space that is going against the wider trend. So there is a tension going on here.
Look, maybe it comes down a little bit, but I don't think it's going to decrease too much. But I think both are true. So the dollar will like continue to be as dominant, but also, like at least on a personal level, with what we do at Wirex, we want to give users the ability to hold their own currencies. We settle with Visa and MasterCard in EuroC as well. We'll probably start settling with them in other currencies as they allow us to do so. We offer on-ramp and off-ramp in other currencies, and we'll continue to kind of grow that out. I think what you mentioned about kind of digital, about currency sovereignty being like really important to the customer from like a choice perspective. But I don't think the dollar is going to weaken in proportion against any of those. I think both of those will grow, but probably the proportion will stay the same.
To be honest, I agree.
Yeah. I want to do my best to help, like, encourage other currencies as well. Just, I like that concept, but I don't think it's going to change anything that's happened over the last 1,500 years.
Thanks for your answer. So on a different note, if you look at the crypto rails, they exist, right? That infrastructure is built. There is no, it's improving, but it's already there. The cost case is proven, stablecoin settlement is live, but mass adoption is not yet there, right? It's growing. We saw it in the previous presentations, but clearly it's still a niche and a minority. What do you think is going to be the inflection point, the catalyzer, the thing that is going to start the exponential growth? Is there a single event? It's just a slow adoption? How do you foresee this evolution? You want to go first again?
My point of view is that, first of all, Genius Act only came out in, 2024?
And it's not enacted.
Exactly, and we're literally in 2026, not even within 2 years' time span. And anybody who's worked within like financial services, banking knows that things take quite a while for there to be an uptick. We've seen it in open banking, we've seen it in neobanks. The early days are always slower. So it's not because some things are shifting that suddenly, everybody's going to, adopt it and or drive it. And I think there's a lot of things that still need to be figured out in terms of how this looks like for the wider financial market infrastructure and ecosystem. So my view is that there is going to be a very trickling trend, which if you're looking at the last 3 to 5 years, it has already happened. So I think we're just really on that, and at some point in time, we're just going to have forgotten to have endless panels about stablecoins. And eventually it will just be a tool that's being utilized, and suddenly we're just going to be in a world where real-time settlement, programmable money, dynamic payments, atomic settlements are just normal. So I do think it's just going to be like a bit of a trickle, but we're also making good progress in the last 2 years. So I don't think that there's going to be this massive inflection and eureka moment where people are going to be like, we now all need to do that, unless there's regulation that says kind of like the no cash policy in the UK, where suddenly everyone's like, oh, only digital payments. That could happen, but I don't think that would necessarily play in a lot of favor, except if it's benefiting the banks.
Dan?
So I just find this quite amusing because I've worked in a couple of credit institutions before, and I don't know if anyone else here has, but you'll probably be acutely familiar with like how committees work, investment committees work. And like what used to happen is you'd want to kind of support a crypto business, Web3 business, and everyone in this committee kind of going, oh, not really sure, like what the framework is. Do we have a legal opinion? And then you get the legal opinion and go, well, I don't know if I can trust the legal opinion. And it's kind of like, oh, I don't know what to do, right? Then suddenly you get like Mika and Genius, and it's kind of a bit easier. You just like someone has a CASP license or someone is regulated in the right framework, and the burden shifts from the bank supporting this business to like, can I trust them? Do they have the right policies? Do they have the right frameworks? And then you can kind of approve these businesses much quicker. So I think, yeah, it definitely is going to, it's going to get quicker now. It's definitely not been one kind of thing, like one bank does it and then suddenly lots of banks support the businesses. Yeah, it's kind of like, it's like slow trickle, and I think we're now seeing like it accelerate.
Yeah, I guess I have somewhat of a different perspective also, but I think it comes from utility, right? Like stablecoins will only grow if there's true value to them. You cannot be ideological about it, that simply because it sounds fancy or like the flowcharts look better than on Swift, suddenly it makes much more sense for everyone, right? So if you think about utility, then right now, until this day, most of the stablecoin growth has come from crypto trading because there is utility, right? So it makes sense for stablecoins to grow because there's a benefit, because foreign exchange from fiat into crypto was cheaper, and that's why stablecoins grew. If you now look into the future, I think there's like two scenarios which you can pinpoint. The first one is that you sort of have this idea that merchants will suddenly accept stablecoins, or global institutes like OEMs, like any sort of global company will go into stablecoin as a means of accepting payments, and I don't think that's the world that we will be living in, right? I still think that fiat is the denominating currency type, if you want to call it that. So the second idea is that if the companies don't start accepting stablecoins, which is like my hypothesis, you can have a different opinion, then at least like stablecoins will be the intermediary part, after which a fiat leg comes, right? So if you think about stablecoins as an intermediary part, then the last leg has to be solved, and equally as good as currently TradFi is able to perform these payments. Long story short, if, for instance, you think about a dollar payment, and the dollar payment now has a stablecoin leg in between, then the sending bank of that last dollar payment has to be up to standards to what a JP Morgan Citi payment looks today. And that's, I think, where still things are lacking, right? So if I make through an EMI, a dollar payment which has a stablecoin leg in before, then oftentimes the payment references aren't up to standards, and things get confusing. Reconciliation is much, much more difficult. And in that way, I sort of agree with this idea that Genius Act will come into play. Banks will start adopting stablecoins, hopefully. Thereby, you will have an off-ramp within a bank. You have a send-out payment from someone like a JP Morgan Citi or an Augustus National Bank that then is easy to reconcile for the recipient, and therefore you once again create utility. I think like the two last examples I would like to give, and actually credit to Wirex, I think if you talk to people on like bin sponsorship, right, and like this idea that previously you would have had to deposit like 2 or 3 days of payment volume with Visa and MasterCard in order to get the contract going, and this is now decreasing, and there's less trapped liquidity, right? And that's like real world impact. And I think the even more, at least like hopefully, let's see, the even bigger use case that we are seeing is like the idea of correspondent banking, right? Banks globally like have trapped liquidity in the trillions or billions sitting in US banks, and that once again goes down if topping up these balances becomes faster and instant through stablecoins, so that over the weekend you don't have to hold like 3 days of payment volume with someone like Augustus National Bank, but only like 30 minutes worth of payment volume, and that's utility, and that will drive adoption. So I think go from utility, look at the use case that actually help, and then get the regulations in place that allow banks to actually interact with stablecoins.
You mentioned correspondent banking, and I think it's a good reference point for the next question that I had. So traditional financial rails are, by definition, the incumbents in the financial space. Like, I've been in crypto for more than 10 years, and there is always, this is the new financial rails, and we're gonna move over these traditional rails, and new rails will come, and they will be blockchain based. Do you think that incumbents will find a way to incorporate this technology in their stacks and they will stay the incumbents? Or do you think that new primitives, new financial rails will emerge from the stablecoin space? Like in 10 years, there is going to be a new financial rails based on stablecoin, or will be the existing one that has adopted blockchain? You want to go first, Doug?
I mean, I feel like there you have to unpack a lot of things that are far more geopolitical than we'd like to all admit, and also unpack the dynamics of banking and the stronghold that it has globally. The fact is, the reason why even regulation was very slow is because banks were very clear about that this is a threat to how we do things today, and it is a threat to our business model, and it's a threat to how we make money. So let's slow our horses and wait a little bit until the banks figure out exactly what that means to them. You have the same for payments infrastructures who have been funneling all the messaging standards in the world. And I think when we talk about who's going to be the incumbent, will it happen? I think they're going to make very sure that the banks have a very important role to play, and who is allowed to do what, to what extent, at what level for value is always going to be stipulated. And this is where regulation and licenses really play a lot of factors, right? And I think the other thing as well to kind of think about, though, is that as much as that is true, today already we're seeing very alternative ways in terms of some of that settlement happening that is clearly not on correspondent banking networks. One great example is Fireblocks. It has its own payments network. You can pretty much, if you're having your corresponding anti-party, counterparty, you can basically already like settle funds instantaneous via that network. And I see a lot of our partners within that network that you already have a lot of that settlement happening that's clearly not going through the banks because everyone's holding stablecoins, so you're like, we may as well do that rather than do the on and off ramp game. The other piece as well is MANSA provides stablecoin liquidity to licensed payments companies around the world. To date, in under 2 years, we've financed over 250 million worth of payments, and it's exactly to what you were saying, Julius, in terms of really making the actual settlement time much shorter, but also the pre-funding needs or post-funding needs much shorter. And if you have that injection of liquidity to the end settlement place already in that layer for the payments company, and why would they use correspondent banking to eventually do the cross-border payment, right? And so we're seeing a lot of the use cases within that, and that in itself is a untraditional, non-traditional way of rethinking what a rail is. It may not exist how we think about it in today's world, and it might evolve starkly. But I do think you'd have different ecosystems of that. You have the incumbent banks, but you're also going to have like alternative, let's say, infrastructure layers.
Yeah, I thought that was really good. I don't have too much more to add. The only thing I'd maybe just say is I kind of break it down into like distribution and settlement. And so like the settlement piece, it's already happening. Like everything is already kind of like, if you're stuck thinking that correspondent banking is the way that I'm going to be doing things, you're kind of already left behind. And so that's the innovative piece. It's happening, and like I don't think anyone again is arguing. Like we're all working in the industry, we're all doing our bit there. The distribution side, I think like you have to work with with the incumbents. They've got distribution. I don't think it's about like displacing Visa or MasterCard or incumbent banks. Like I think the best way to do it is to kind of like almost what you were saying, let them figure it out, work with them, and kind of get the distribution that way. Like that's how I see it.
And just one last thing to note, which I think is often forgotten. We're talking about a $250 trillion TAM. Like not one player, not one rail like has ever taken that all. And I think that's important to always put into perspective, and it keeps on growing. So it's healthy if we're not all on one system, on one way to do it, right? It needs to be diversified, and different geographies, whether it's LATAM, will need different things than, for example, the US or European market. And those are all the factors that play into that, I don't know, that the focus on who's going to win it all is a bit arbitrary at this point in time, yeah.
I also think that, I mean, on this point of looking at different geographies, look at why European stablecoins don't have seen any uptake. It's partially also because SEPA isn't totally shit right? I mean, look at ACH, like it's a completely legacy rail. There's like chargebacks on there, it takes 2 days, there's fees involved, a lot of payments get stuck. SEPA works fairly well, right? And if you're competing with like a proper RTP rail, then it's much more difficult for stablecoin rails to create adoption, simply because competition is much higher. Whereas in the US, if you look at ACH and then also the correspondent banking network, where little innovation has happened and little strides were made, a SWIFT payment today, and this is a fact, is slower than it was a year ago on average, which is like, why are you guys not getting any faster? And if competition is low, then I think stablecoin adoption can grow. If in certain markets RTP is already there and is providing great benefits, so that the stablecoin, additional benefit is somewhat limited, then I think it will be more difficult for it to grow in adoption. And I think the last thing is like this general idea that if stablecoins grow like massively in adoption, and let's say there is a world where they make up 20 or 30% of global payments, then I think the definition of a bank will also shift. So this idea that governments will always want to be in control. Like the idea of a bank is not necessarily for it to always be tied to TradFi. It's more so that the majority of payment volume and deposits or like balances, the government wants to have an extremely close tie on. So if you think about a world where 30% of ACH and SWIFT volume gravitate towards stablecoin companies, then I think what will happen in the US is the OCC will simply shift the definition of what is a bank today and say like, hey, all the MTLs and all the trust charters that are interacting with stablecoins now all of a sudden need a banking license in order to keep doing their business, because otherwise they fear of losing control. And I think that's like something that is somewhat underestimated in terms of the consequences this will have on how the regulator looks at it. So yeah.
Okay, so we basically agree that there is going to be an organic evolution towards blockchain and towards a different way of settling stuff. So what will this settlement layer look like? It's going to be a stable coin, it's going to be a token, it's going to be a layer, it's going to be a protocol. How does it look like?
I don't think it's any of those things. It's probably like just the stack in combination. So it's like
system,
it's the system. It's the programmable money element. It's the chain. It's the identity layer. It's the compliance stack. Like all of that, I think is stitched together. It's kind of what wins. I think it's like who chooses who wins. It's basically the best version of compliant money. And I don't want to say anything too controversial because I don't want my panelists really disagreeing with me.
Go on.
But no one really cares about stablecoins. Like you and I, like we really care about stablecoins. Like this room really cares about stablecoins. But most people do not care about stablecoins whatsoever. What they care about is things work really quickly, really cheaply. It's really convenient. But like what happens on the back end, they don't really care. I mean, think about it. If you go and like use your card at a payment terminal, I mean, maybe I'm being too controversial now, so apologies.
I don't think you are.
In advance. But like, who knows exactly how all the like intricacies of how that card payment works? It goes to acquirer, to a PSP. Like, you don't know any of that. Majority of users don't know any of it. And it's the same thing, I think, like the future that we're heading towards. Not like stable. It's kind of like, does this work beautifully well? And hopefully it's stable coins on the bottom, but it might not be.
Julius?
Yeah, I think backend is the right word to put it, right? I don't think it will be the front end, I think it will be the backend. And in that way, it will be part of the stack and not necessarily the whole application itself. So I sort of agree with, against what you believe, I sort of agree with what you're saying.
I'm just being provocative, so.
I don't think it's that provocative because, I mean, honestly, I do think we talk about like, stable coins and what stack it needs to sit on and or smart contracts, protocols, tokens in a way where I'm like, this is absolutely redundant. The only thing that should matter is that you're designing something for efficiency purposes and value creation. It should go back to ultimately what the user wants, whether that's a consumer, whether that's a business, and making that sure that that is a reliant system that is also secure and that's operational and participatory for everybody in that stack, right? So I do think it's going to look more of a hybrid because just, it's kind of like what we've seen in the cloud transformation space, which is like, you're never really getting away completely from the original stack. There are still loan tapes sitting, on disks somewhere in some bank in London, even though they've gone through their cloud transformation. So there's plenty of things that probably will take a very long time, maybe 50 years, to completely erase. So it will require all the great tools and all the great, I think, innovations and technologies that have come to fruition in the last 10 to 15 years. And we should be using them, and we should be all using them in a how do you say, systemized fashion, so that it makes sense. And I think that's what hasn't made sense in the last couple of years, which is just everyone's going on different trajectories, and we're like, can we just come together, make it make sense, have a standard, work towards that standard? Just again, we've seen it in SEPA or open banking, etc. Those things work because there was a vision that people went behind.
There is also centralized nature behind that. Like SEPA is a centralized entity that, it's a rule book that is agreed on, coordinated by a central entity. We're not going in that direction in this space, right?
Because we've chosen not to.
Yeah,
we could have chosen, banks could have easily 10 years ago, participating all on SWIFT, been like, guys, great new technology, let's all sit together and figure out what this looks like, come to a standard. It's been done time and time again. This one, we just dropped the ball. That's my honest opinion, but I think the ball was dropped and we could have done a much better job to actually get behind, rather than having all these random initiatives and projects going on that are moving the needle a little bit, but also creating security issues, compliance issues, and fearfulness in terms of this adoption.
Yeah, I also think there's sadly, there's this unnecessary debate going around yield, which sort of disturbs the way that banks in DC think about stablecoin adoption. This is actually, there's a long story to this, but actually, let me tell you. So there's you guys might know BIS, right? So the folks that define how leverage ratios are calculated within banks. And 40 or 50 years ago, there was a big discussion going on whether or not if a bank simply holds cash on its balance sheet, this should tie into its leverage ratio. And at the time, they decided against it, which is probably the main reason why there's such a fierce debate now going on stablecoin yield. So essentially, if I open a bank today and I sort of take deposits and I simply keep them in cash, I still have to contain 6% equity if I'm a GSIP. I have to contain 10% in our instance as a de novo bank in capital, right? So I have an equity requirement which I have to fill in order to keep those deposits, even if it's cash at the Federal Reserve, right? And a stablecoin issuer doesn't have to keep that equity slice. And this is where the entire business model of a bank is attacked at its foundation. And this is also the issue. If 40 years ago, banks would have come together and find an agreement that if a bank simply keeps cash, it's not calculated into the leverage ratio, then the return on equity, this is very financially now, and I can also happy to explain it afterwards in more detail, then the return on equity of these banks would not be capped, and they would be able to perform similar business models to stablecoin issuance companies such as Circle or Anchorage, wherever it might be, or Bridge today, so that they don't need more equity to scale their deposit base. And I think this is where, if you look at, the other day, Jamie Dimon called Brian Armstrong, what did he call him, a total idiot or something? He totally attacked him on TV. And the main reason is exactly this yield debate, which somewhat goes away from what we've been discussing over the last 30 minutes, right? So the discussion of, or the defensiveness on banks doesn't come from stablecoin adoption not being a good alternative to legacy rails. It comes simply from the fact that the way that the leverage ratio in the end is calculated is different, and that therefore their business model would be intact in its core, which is net interest income.
Yeah. Closing round before giving the opportunity to ask a few questions. So it's 2030. You think we're still going to have another panel like this, or the shift is done and it's a fact?
Yeah, let me take the first one. I still think that traditional payment rails will be the predominant factor.
Oh, no.
No.
Okay. Dan?
No, I don't. I think we'll be talking about far less tedious things, is non-custodial finance going to survive? Is it going to have any uptake? Is it going to be some of the other elements I mentioned about how compliance fits into all of these? But stablecoin for cross-border settlement, I think it's a done deal.
I don't know. I'm going to play devil's advocate and say yes, because 2030 is only 4 years away. the pandemic was 6 years away, and it feels like it was yesterday. So I think we're a little bit too optimistic about how little we like to talk about things, because we love to sit on topics. Maybe it won't be exactly on cross-border payments and settlements, but it will be a flavor, it will be a version of it, and it will still be on something. I mean, we talked open banking to the death of it. Like, I think up until last year, there were still open banking panels at Money 2020. And so,
I mean, fintech people likes to talk a lot.
We just love to, like, you have to remain relevant, right? So we just love to be on stage.
Crypto industry is a byproduct of the conference industry.
Exactly, and who knows, maybe we'll be talking about like quantum plus stablecoins then, but we'll definitely still be talking about a version of it.
Cool, thanks so much. Is there any question from the audience? Yeah, Nadia.
Hey, thank you for this discussion. It was great. I want to ask one question. I mean, I have been building stablecoins as well some years back. And I mean, for me, stablecoins, if you use Apple Pay or Google Pay, it's basically a private stablecoin that is running in the back. If you are trusting this company, they have a token somewhere and they're moving money for you. My question is, like, apart from getting VC funds, what are reasons that we actually should be investing in using stablecoins?
So one of the things we doing at Wirex is offering this kind of retail and business banking proposition, or banking as a service proposition, that runs on stablecoins. And the reason we're doing it is because it's much easier to scale a global fintech business that runs on stablecoins than it does on fiat infrastructure. I mean, the guys here will be acutely aware of how difficult it is to grow your business, a regulated business in each jurisdiction. It's got its own licensing, its own processes, and I think that it's just much easier. You used Apple and Google Pay as an example. Like, one of the things we can do is top up via Apple and Google Pay, and on the back end it just goes straight into stable. Or, for example, you use your card and it's linked to your external wallet.
But why do we bridge to the stable? I mean, we have Apple and Google. I mean, I have different.
For you and I, it's probably not that big a difference, because, like, we live, I don't know, in the UK or Europe, or we've got like SEPA Instant that works really well, or faster payments. But other jurisdictions, they have like horrible scenarios. Like, it's just not very easy to use their products in Argentina, for example, or other jurisdictions. So I think, like, for them, like, it's actually solving like really helpful things.
But I also think you need to decouple a couple of things. What is a financial instrument that's being leveraged and used, right, in the back end, which is ultimately, like, if you decouple of what is happening in terms of representing that value that has previously been held in fiat, you need to decouple that from, oh, I am a consumer and I'm making a payment. Because if you're saying that at the back end of Apple Pay and whatnot are anyway still using ultimately like a token and or to move that value, it's the same. It's like, you know, you might just not experience it, but things are still being utilized, right, for efficiency purposes. And I think the other point is to note as well is, like, money is only a concept. We have invented money, always have. We've gotten so passionate about fiat, and I'm like, fiat is an invention in itself. Value is an invention. We used to barter with cowries and whatnot, and now we're just so dead or die on, like, this fiat concept. And I'm like, call it digital money, call it whatever you want. Like, let us just focus on, like, if there is a delay and or inefficiency within a system, we should cure for that. And in many places, to your point, outside of Europe and the US, and even the US still, to your point about ACH, there's inefficiencies. And it's because the way fiat was invented has been rigid. Now we have a less rigid logic we could follow. Cool, let's design it and follow it, right? So that we have more efficiency, so that maybe you can generate more yield, like, or maybe because you can get your money more efficiently and less money is trapped. At the moment, there's $4 trillion trapped in pre-funded accounts sitting across different regions, so that you have a Revolut experience or a Wise experience where you think money is moving real time. It's not. it's internal accounting, right? So if you're having stable coins, then it's like just another concept of that. That's my view on it.
Last one, Julius.
Yes, so I spoke to a Brazilian bank yesterday, and they have a Citi account. And essentially, if they want to top up their dollar balance in the US, it takes them like 2.5 days because they have to go through a Brazilian FX desk, which then accepts the BRL, sends a dollar payment out, and that takes like 2.5 days, right? So if I talk to them, and I'm like this, in the grand scheme of things, extremely small bank that is now opening shop in the US, I can tell them for a fact that, hey, you guys have stablecoin rails, right? And they go, yes, we have stablecoin rails. So no, why don't you simply take the BRL, convert it into USDC, because that's like a proposition which they have for their own Brazilian customers, and you send us stablecoins, which we can accept, which Citi cannot, and that shrinks down the 2.5 days to 10 minutes, right? And then this all sounds fancy, but where's the actual implication? It's exactly cost of capital, right? Because if these guys would want to mirror that instant experience which they can get from us with Citi, in fact, they would require them to get a payment advance, which they have to pay like 15% interest on for 2 days. You can do the math, it's incredibly expensive. And I think that the last example is real-world examples matter, right? Like, why is it important that money settles instant? It's because, for instance, if I'm a Brazilian importer and I pay like a manufacturer in the US, these guys might only ship the goods as soon as the money is settled. So if it takes 3 more days, then goods are only shipped out, dispatched 3 days later. If I make a payment to an FX desk and it takes 2.5 days, then I might have FX exposure for 2.5 days, which is a risk to my business. I can hedge for that, which is another cost. So there's like always, I think if you go one level deeper, apart from just saying like, hey, stablecoins look and feel nice, to the things that matter, as to your point, then I think there's like a ton of efficiency to be levered up and costs to be decreased.
Okay, I think we have run out of time. I wanted to thank Nkiru, Daniel, and Julius, and yeah, thanks a lot.
And yourself.
Thanks so much.